Life Management Science Labs would like to acknowledge that we live and produce this podcast on the traditional lands of the Wurundjeri people. We'd also like to acknowledge the traditional owners of the lands of our listeners and our international colleagues. We'd like to pay our respects to their elders past, present, and emerging. Hello everyone, and welcome to Wealth Pathways, the Affluence Science Insights Podcast produced by LMSL, the Life Management Science Labs. We are champions of life management science, providing structured insights informed by science and inspired by practice on key aspects of conscious living. Each week, we bring you scientific and practical insights on each element with the expert knowledge of professionals in the field. I'm your host, Marie Stella, coming to your ears from Naarm, Melbourne, Australia. Let's learn together. Hello and welcome back to the show. ETFs have revolutionized the way that people invest, offering a diverse and accessible way to build wealth. These investment vehicles provide exposure to a wide range of assets from stocks to bonds to commodities and real estate. But to novice investors and outsiders, mystery surrounding the world of ETFs remains. So, in this episode, we aim to demystify the world of ETFs, examining their benefits, risks, and how they can potentially fit into your investment strategy. And joining us in this conversation is business lecturer Marta Khomyn. Situated at the Adelaide Business School, Marta teaches business analytics and does empirical research on passive investing, high-frequency trading, exchange-traded funds, market efficiency, and so much more. And that aside, she consults for the World Bank, evaluating the economic impact of digitization projects in developing countries. So we're extremely fortunate to have her here with us today. Welcome to the show, Marta.
Thank you.
It's
Good
great
to
to
be
have you.
here.
Yeah, it's great to have you here. So before we begin, tell us a bit about yourself and your background.
Sure. So my career is centered around curiosity around how to do better with money. Okay. And that can manifest in different ways. That can be about investing, saving, spending, or donating money. I teach business analytics, which is all about how to use numbers effectively, how to use data, in other words, to answer questions around money and more. And my research is about how markets work. So I like to ask questions that help with allocating money better and also help regulators to regulate the financial markets in a way that maximizes the benefit to investors. The topic that we are covering today, which is about exchange-traded funds, I think has potential to benefit a lot of people, young and throughout the investment journey, really, because those products are well positioned to help investors avoid very commonly made mistakes. In other words, it's very easy to diversify with ETFs, and it's easy to use them for broad market exposure, which I believe can have hugely beneficial effects for anyone who tries to invest for the long term.
Yeah. And what's a common misconception that you've heard about ETFs?
Well, I think people perceive them as riskier than individual stocks, which is kind of probably number one misconception, because ETFs are diversified products most of the time. There are different types, but the plain vanilla ETFs are diversified products designed to track broad market indices, such as ASX 200 or S&P 500 in the US, or the world indices even. So those plain vanilla ETFs that invest in a well-diversified portfolio of equities only carry the what we call systemic risk. Systemic risk is this risk that is just the risk of the market overall fluctuating with ups and downs as the economy experiences the ups and downs of the business cycle. But the idiosyncratic risk, or company-specific risk, in other words, is diversified away in those products. So it's much safer. There are fewer fluctuations, in other words, when you invest in a product such as an exchange-traded fund than if you invest in one stock or two stocks or even 10 stocks. Okay, so I think that's probably the number one misconception. And it stems from the lack of understanding of what an ETF is. It's not anything exotic. It's just a fund that happens to be listed on a stock exchange. And it makes it very often cheaper in terms of management fees compared to traditional funds. But also, it makes it easier to get in and out of the fund. So redeem your funds or sell your ETF if you happen to need the money. Okay, you got a super expensive tooth operation or something. You need to go to a dentist. I like to give that example to my students. It's an expensive exercise to go to a dentist in Australia or the US. So if you happen to need a dentist and you need to raise the money to do so, you may easily sell ETFs during daytime trading hours on the Australian Stock Exchange if you happen to be located in Australia. And then, it has that liquidity advantage in addition to being a well-diversified product that offers you broad market exposure.
Yeah, that's a great preface for our topic for today. But before we go further into detail, I would love to get to know you better. So this is Have You Met Marta? And my first question for you is, what do you enjoy during your spare time?
Yeah, so I enjoy lots of things. I love sports. I run several times a week, including trail running. I love rock climbing as well. So a bit of controlled risk is always helpful. It's not just about finance, but also about managing risks in your real life, and taking up the controlled amount of risk is very often brings up the colors of life. There's also dancing, which is something I've been doing for many years now. I love Latin dancing, and I love really different kinds of dancing, not just Latin, but mainly Latin dancing. Is one of my ways to relax and recharge.
Yeah, that's really interesting. You seem like you're one of those people who stays really active.
I do, yeah. I love staying active.
Yeah. And are there any books, movies, or TV shows that you've enjoyed recently?
Oh, absolutely. We just had the Adelaide Film Festival here over the last week or so, and this year I went to see The Correspondent, which is a movie based on the true story of Peter Greste, the Australian journalist who was arrested in Egypt years ago, and it's about the freedom of expression, freedom of media, which is something I care about a lot. I also love movies like Poor Things, Stutz, some of the ones that come to mind.
Yeah, I did love Poor Things too.
Yeah.
Yeah,
that was my discovery from last year's Adelaide Festival. I recently rewatched it as well.
Yeah, it's really good. So, what type of films do you tend to enjoy?
Well, I don't watch films very often, so it's either someone recommends something to me. I think that was the case with, say, this Japanese film. Was it Happy Days, Simple Days, Perfect Days? Perfect Days, yeah.
Don't think I've heard of it.
Yeah. So it's usually on friends' recommendation, and I love independent films as well. So I like to discover them during various festivals or through friends. but
Yeah.
not very often that I'll find something just browsing Netflix. I don't really have Netflix or other streaming services. Yeah.
Yeah, for sure. I do find it difficult to pick a movie just scrolling through Netflix. It takes me so long.
Yeah.
I fare much better finding like a good movie from word of mouth.
Yeah.
Yeah.
Yeah. Yeah.
So either in your professional life or your personal life, is there anyone in particular that you look up to?
Good question. I probably gain lots of inspiration from my friends, and I have a variety of friends with the different backgrounds, and
Mhm.
it's less about having the one person that I look up to, but it's more about finding different qualities that I admire among different people. So someone could be a great listener, and someone else could be I don't know, a great marathon runner, and someone else could be something else I admire. And I think that makes life so much richer to draw inspiration from that.
Yeah, I like to frame things that way as well. That's actually one of the next few questions I tend to ask my guests, which is what traits do you tend to admire in the people that you look up to?
Yeah, I let me try to pick three
Hmm.
traits so that I don't speak for another 2 hours.
That's so fair.
Kindness is a big one, which is something I've kind of rediscovered recently. As I'm going to take kindness over intelligence or anything else, really. I think it's
Mhm,
so important and
mhm,
helps us to relate to one another and be
mhm.
compassionate with one another, which is really what truly connects us.
Yeah.
Um, I do admire grit and stamina and strength, which
Mhm,
are this various aspects of having a strong core and being able to grow from that
mhm,
place of strength. And I guess by strength, I mean strength of character, strength to persevere, strength to become better and serve
mhm,
others. And let me try to pick the third one. Um, let's see. I do admire intelligence in people as well. I just can't avoid it. I'll put it in the humble place number three. But there are so many different kinds of intelligence, and I
Yeah.
admire not just the intellectual intelligence, but the emotional intelligence. Just this little spark that everyone has that makes
Mhm,
them so good at what they do, and everyone has that about them.
mhm,
So it's fun to discover that special intelligence of a person, whether it's the emotional side of it, the intellectual side of it, the physical side of it. Um, yeah, so some unique talent. Yeah.
Yeah, for sure. I agree with you there. Well, thank you so much for sharing all of that with us. It's been such a pleasure to get to know you a bit better. Now let's move on to the interview. And for starters, how would you define affluence?
Well, to me, affluence is about freedom to live the life you want to live. And we all need financial resources to do so. Um, there's this phrase that I remember from the time that I started studying economics during my high school, grade 9 or so. And this tagline, if you like, of what economics is about allocating resources to satisfy our limited resources, allocating limited resources to satisfy our unlimited needs. Yeah, and so there's this notion in economics that our needs are potentially unlimited, which I had really hard time wrapping my head around, because at the time I thought, look, it's not that many things I really need. I can be happy with thing 1, 2, 3, like whatever I was at that point, being a student, a high school student in Ukraine. I can, if I have good grades and good family and satisfy like the basic needs to travel and eat and so on, I am fine. Yeah. But kind of revisiting that notion of unlimited needs these days, I think people's ideas about what they need do vary. And I can very clearly see that as I've lived across different countries over the years. But in the end of the day, affluence means that one is not constrained to put up with circumstances or people just out of pure lack of financial resources. Okay, so affluence can be defined quite differently depending on circumstances, but I very often relate it to the freedom to live the life that one can envision for themselves at a given point in time without the need to sacrifice their needs because of circumstances.
Yeah, for sure. Like I don't need well, it is recommended to have a dental checkup every year or so, right? But in order to like actually survive, I don't need it. But it would be nice to be able to do that without financial constraints, right? Yeah. Something. Yeah.
Not many people would think of dental checkups as the kind of as the example here, but it's admirable.
Yeah. It's been a while. It actually hasn't been a while. I did get my teeth checked a year ago, I think. So it's due soon. So that's on my mind. But anyway, so with ETFs, what are they? What do they stand for?
So ETFs stands for exchange traded funds, and it's a financial product that allows people to buy a share of a fund that diversified on your behalf into many stocks. Okay, and what those many stocks are is in the name or in the prospect of the ETF. So they tell you, look, on your behalf, we've already created a fund that, let's say, invests in the 500 largest companies in the United States. Let's say it's an S&P 500 exchange traded fund. So we've done the work for you. We've created a fund that invests proportionately to market cap of these 500 stocks as defined by the index. And now we're just issuing, let's say, these little pieces of paper or little electronic pieces of paper, if you like, that you can buy and be entitled to the performance, so the fluctuations in price of that index, of those 500 companies combined.
And apart from the S&P 500, what are the other various types of ETFs available?
Yeah, so there are really many types. As you mentioned in the intro, the exchange traded funds can invest in not just equities, so not just companies, but also in the debt of companies. So there could be fixed income, what we call exchange traded funds. There can be commodity exchange traded funds that, let's say, invest in just one thing, gold, or several things like gold and platinum. There are also riskier versions of exchange traded funds that take leveraged exposure. So you can invest in 3 times leveraged S&P 500, which would mean that you get, if S&P 500 goes up, let's say 10%, you get 3 times that. So you get 30%. If it goes down 10%, you get 3 times that. So minus 30%. Yeah. So those are more exotic ETFs, and people can gamble with them. When I constantly give the example of S&P 500 or World MSCI ETF or ASX 200, because I think for the purposes of long-term investing, equity ETFs are most suitable. No, but that said, you can also, of course, create your portfolio using a variety of products out there. And there's really many of them, including ones that just invest in one stock or one commodity or Bitcoin or anything out there, really, you name it.
Yeah. And in short, how would you describe ETFs as a form of investment when it comes to like taking into account things like risk factor and the barrier to entry, for example?
So the risk of ETFs is really defined by what they invest in. Okay. So ETF as such doesn't itself as a kind of abbreviation, as a type of product, doesn't necessarily carry all that much extra risk compared to a fund. Of course, you want to know who the issuer is, and there are well-known issuers like State Street, Vanguard, BlackRock that are well reputed and so on. So there is that extra risk of who's the company that set up the fund. But other than that, it's assuming it's a reputable company. It doesn't add that much extra risk just for the fact that this is an ETF as opposed to a mutual fund or well, I guess the only comparable thing is the mutual fund.
Yeah.
So really, the risk is dictated by what this ETF invests in. And to give an example, a 3 times leveraged ETF on S&P 500 is going to be 3 times riskier. It's going to fluctuate with 3 times wider fluctuations compared to S&P 500 plain vanilla ETF, which doesn't take on extra leverage and just fluctuates with the index. Okay. Now, how risky is the Australian government debt ETF, let's say? Well, it's as risky as the Australian government debt securities that are included in that ETF. How risky is the gold ETF? Well, it's as risky as gold. Okay, so gold fluctuates in a certain way depending on market conditions. It can be deemed a safe haven asset. Well, ETF just gives you exposure to that. Yeah, so there are a few extra risks that one can be aware of. In addition, like what's the difference between investing in gold and investing in gold ETF? Well, there may be tracking error. There may be slight differences between how well this ETF replicates that price of gold. Gold is maybe not the perfect example, but there are slight tracking errors. You didn't buy the stocks exactly the same day, maybe when the price of the stock was included in the index, let's say. There are slight minute differences, but really, broadly speaking, the risk is just what the underlying asset risk is.
Yeah. And I've got to say the plain vanilla ETFs do sound quite appealing for the minimal risk factors, particularly with the S&P 500 and low barrier to entry, right? But so what are the reasons that people opt for individual stocks as opposed to ETFs?
Well, mostly it's the lack of understanding of ETFs and perhaps the ability or the need perhaps to gamble. Yeah. So people like perhaps if I have a view on what NVIDIA is going to do in the whatever next week or next month, whether it's going to go up or down, maybe I want to just invest in NVIDIA. Maybe I have a view of what Trump's election is going to do to the stock of Tesla. Okay. To give a recent example, well, I think Tesla is going to do particularly well. Maybe I want to specifically bet on Tesla. So if I have those gambling reasons to take a view and take a long or short position in a given company based on that view, then makes perfect sense for me to invest in individual stocks. But that would maybe is not the right word here, because I'm really trading that, right? So if I have that trading reason, that gambling reason to buy or sell stocks, then stocks are probably a better option. Yeah, but going back to my first reason I gave, very often people say that they do not understand what ETFs are, and so they'd rather buy stocks, or even, it's a lot of trouble. And if I were to replicate the S&P 500 index, I need to buy 500 individual stocks, rebalance my portfolio to keep it in check, right? So I could try to do that, but I probably need to spend a lot of time doing so. Similarly, maybe I don't understand ETFs, and so I just go and buy a mutual fund instead. I understand what a mutual fund is, right? So that's another reason.
Yeah. And what are the main ways to start investing in ETFs? Would it be through a broker or a provider or something like that?
Well, so you're asking about reasons or channels for how to invest?
Channels, I suppose, like the main way to do it. Like, how do you go about doing it?
Yeah, so that's very simple. Basically, what you need is to open a brokerage account. If you have a bank that you have a savings account or a credit card with, most likely that bank is also provides some brokerage services. So any major provider like CBA or NAB or Macquarie would have a brokerage arm. So you can check which, you can even just Google, open a brokerage account, and doesn't take, much trouble. You open that brokerage account and you connect it to your bank account, and you can then put some money into your account, into your trading account, and you'll have a little window that says, what would you like to buy? Yes, you now have to decide which ETF you want to buy, and you just type in the name of that ETF. It's called a ticker. You need to find out what the ticker of that ETF is. Let's say it's IVV or some other ETF. And so you take that ticker and you select whether you want to, buy it at a certain price or place a market order, or if you're willing to accept the market price, you place a market order. If you want to, maybe wait for the market to move closer to the price you're willing to accept, you place what we call a limit order, right? So in other words, you're just typing in the name of the ETF and the price into your brokerage account window, and you can start with, very small amounts. It's easy enough to buy $100 worth of an ETF or $200. Don't have to have huge amounts.
Yeah.
Right. And so once you place that order, and once it gets executed, it's pretty much an instant process. You have sitting on your trading account an ETF. Okay, so it's just this electronic way of tracing that, hey, now you have exposure. Your $100 went towards, let's say, S&P 500 ETF, and that ETF, that $100 is going to go up if S&P 500 goes up, or go down if S&P 500 goes down. I recommend not to look whether it goes up or down. If your idea is to hold it for the long term, it's just going to do its thing. On average, it's going to go up over a long period of time. Markets typically go up. You can look at the chart of a market. So this line that sort of goes up and down a little bit, but overall over 5-10 years, it goes up as markets grow. And because the 500 companies in the US, hopefully, it's not like they're going out of business all at the same time. And it's not like they are going down all at the same time, although occasionally it does happen, like during crisis. Okay, so that's basically that. There's 2 steps. Open a brokerage account, buy an ETF. I recommend checking very carefully what the management fees are. And so when you're selecting an ETF, one, you want to decide what is your product like that you want to buy. And typically I would recommend well-diversified ETFs, so something that invests in the broad market. If you have a view that the US is going to do better than Australia, maybe buy the US. Maybe buy a little bit of the US, a little bit of Australia, a little bit of the world overall. So ideally, the best diversification is the exposure to the global world market. But again, you may have views on what is going to do better. Yeah. So if it's going by the book, diversify into the world overall, which can be done with one ETF or 2 or 3 ETFs. Yeah. And then check what the management fees are, because management fees are the definite percentage that gets deducted from your return on the index. So I have a paper on this, and very often issuers offer several different ETFs. So there are 3 ETFs that track the same index, and they may have different management fees. Yeah. So you just want to pick the one that has the lowest one. Okay. The lowest fee ETF, something like 3 basis points, 5 basis points. 5 basis points is 0.0005. Yeah. So it's like 0.05%. It's very low management fee, but there are ETFs out there that charge way more than that, and that's unnecessary. So you want to make sure you pick the low fee product. Typically issuers like Vanguard offer the lowest fee products in the industry. So they have a reputation for being the lowest fee, but you don't have to trust the brand. You can always check what the fees are, and it's typically disclosed in the ETF prospectus. Okay.
And apart from management fees, is there anything that needs to be considered when picking a broker?
Yeah, so let me just clarify this. Yeah, brokerage fees are different from ETF fees. So when you're picking a broker, you do care about how much they charge per trade. Okay. Some brokers charge per trade. Some brokers charge as a percentage of the value of the trade being executed. When picking a broker, so this is step 1, opening the brokerage account, you care about the trading fees if you're going to trade a lot. With buying ETFs as an investment vehicle, you want to maybe buy it once and keep it and not sell. That's sort of the idea with investing for the long term. So the fact whether you pay $10 or $15 on this one trade that you execute, or 3 trades if you're buying 3 ETFs, it doesn't make such a huge difference. Yeah, so you may check what the fees are, and you can kind of by Googling for maybe 15 minutes, you're going to find out who the cheaper brokers are. But it won't make that much of a difference. Brokers may offer various services like apps to track your portfolio, or research on different companies. if you're just investing for the long term and investing in ETFs, I would not necessarily recommend going for the flashiest apps and kind of trader focused types of brokers because you probably won't be using it. You also, it's not the same as the bank that you need to trust that this company won't go bust. So you put the money on the account for just this period of time between now and when you buy your ETF. So you do want a trustworthy company, but it's not like your money is going to disappear just because the bank goes bust. It's not. Reputation still matters, but it's less sensitive to all these credit considerations that people may have when opening, let's say, a savings account. So pick Google around, find the bank or the brand that you trust, check their brokerage fees, but mostly picking a broker is not such a major topic when investing in ETFs. It's picking the ETF. Okay, so a broker and an ETF are separate entities altogether. A broker is just your means of putting the trade in. It's if you want the analogy, it's like, I know that I want strawberries. Now, where do I get them from? Do I go to Coles, Woolies, Adelaide Central Market, or a local corner store? It's assuming that strawberries are roughly priced. I mean, again, not a perfect analogy, but they're probably priced pretty similar. It's like, in fact, the analogy is totally imperfect here because the ETF is going to be exactly the same price everywhere. I'm accessing the market. It's just, where do I get this access to the market from? Through which shop? And so it doesn't matter very much. What really matters is selecting what is the ETF that I'm going to buy. So like, what's the underlying asset that I want exposure to? Is it like equities for the long term? Is it commodities? Is it something else? If you're just investing for the long term, trying to build wealth, investing in the broad stock market is a better idea. So you selected your ETF, and then you open your brokerage account. Doesn't matter all that much which broker you go with. But then what really matters is picking the ETF that has low fee among the ones that offer, let's say, S&P 500 or offer Australian government bonds or whatever your exposure is. Just Google which ETFs have that exposure and then pick the ones that have the lowest fee. Because that fee will be deducted from the return for sure.
And what are some of the most common mistakes that newer investors make when investing in ETFs?
Well, I've talked to some of my friends who wanted to invest in ETFs, and I can tell you kind of anecdotally what I see is that people try to, let's say, chase, let's say, ESG. Okay, so environmental, corporate, and governance type ETF, right? So they believe that doing so makes them more ethical. Now, this is unpopular, but like it's a marketing tool. Okay, so you're going to pay 10 times higher fee just for the fact that there's 2 companies excluded from the index. If you truly care whether this 0.01% of your portfolio is in this company or that company, just find an ETF that doesn't have them in there and that doesn't brand themselves as ESG. But broadly speaking, if you really object to coal, well, don't invest in Australia, invest in some other market. Okay, but that's just something I've seen from my experience. It doesn't make a whole lot of sense, and people who work in that industry know that unfortunately it's used more for greenwashing, this sort of branding of ETFs as ethical or ESG or something else. But if you really believe like you can't help yourself, you just really want your ESG ETFs, again, apply the same principle. Find among all the ESG ETFs that exist, and there's many, the ones that have the lowest possible fee. Okay, so at least in that sector that you consider, pick the one with the lowest fee. So I guess, like, broadly speaking, the mistake is to pick ETFs based on branding as opposed to based on fees. What you care about is lowest possible fee for the ETF that you're choosing.
Yeah. And with all of the technological advancements that are emerging at the moment, what do you see in the future of the ETF market?
Well, ETFs are getting more and more exotic. So in the US, ETFs have become a little bit like a way of executing trades that used to be delivered by trading desks of large banks on demand to large investors. Let's say I have long exposure to one type of asset and a short exposure package into the same product. So then ETFs become a wrapper for a particular trading strategy. So that's a kind of it's among the diversity of ETFs that exist in the US that there are these more exotic types of ETFs that try to satisfy investors' demand for, the latest hot thing, whatever that thing is. Maybe it's a Bitcoin ETF. Maybe it's a largest tech stocks. So let's package 10 largest tech stocks into an ETF. There's a new type of ETF recently which goes long and short, so takes long position in, let's say, AI stocks and short position into older tech companies like Intel, so that it helps investors express a view of some kind. Now, that's not that's sort of the extreme example of where the ETF business can go, satisfying these niche demands of investors. But in general, in this plain vanilla market, ETF fees are going down. Yeah, so there's more competition among different issuers offering broad exposure to, ASX 200 stocks. And so if you have three issuers offering the same ETF, they'll try to cater to different investor clienteles. And the ones that offer lowest fees are going to attract the investor clientele who invests in ETF for the long term, because that's where I care about fees. If there are issuers that have very liquid, easy to trade products, their clientele, which are more institutional investors who maybe use ETFs for things like hedging or tactical allocations, they would care more about liquidity and ease of trading. So can I execute $1 million worth of a trade in this ETF instantly without moving the price? They'll care about that than what the fee is, because that fee, if held only for one day, is going to be not really much for that investor who trades rather than invests for the long term. So yeah, there's that dynamic too. Competition among issuers on fees and differentiation across this liquidity versus fee dimension. Okay.
Yeah, interesting. Okay, so with regards to practices and habits, what is a habit that you recommend practicing to familiarize oneself about with the ETF market and staying informed about all of this?
Well, a good place to start is just to Google the products that you're interested in. Let's say I'm interested in investing in MSCI World ETF. So I want to Google that, find which ETFs are out there, and I'm going to then find, okay, this is the product that, let's say, Vanguard offers. And then I can read their prospectus, which is probably 1 or 2 pages worth of text and numbers about what this ETF is. And then I can look at the graphs, the historical performance of that ETF, and maybe to get comfortable with what it is, what this product really does, I could check that chart of that index daily, or the chart of that ETF, which is going to be pretty much the same as the chart of the index. And so I can do that for, I don't know, a week, and maybe Google different aspects of what fees they charge, what is this company that is issuing that ETF, what they are, what is Vanguard, what is BlackRock, what do they do, what do people say about them, and so just checking what this thing does over the course of a week can make me a bit familiar with the market and the issuers. And then I can decide on, okay, like, am I prepared to take that risk? And by taking that risk, I mean, I can sort of almost simulate in my head, look, if I invested a year ago, my money would go from this point on the graph to this point, or from this point maybe to that point down there. If I invested 2 years ago, it could have gone this way. Maybe if I was unlucky and I invested between, like, I don't know, January 2020 and then in March 2020 everything went down. What if I needed money at that point? Oh, this would feel this not so great. So I can kind of simulate these different scenarios. This is what I mean by understanding what risk is. And the risk here is really about, if I invested here and market went there, I would lose this much. If I'm prepared to wait for 10 years, it's very unlikely that the market that there would really be like down a lot, because over a long horizon, this overall tendency is to go up. But I could have been unlucky and it could have gone down. So I can kind of almost like put myself in different places on the chart and sort of think about it.
Yeah.
But in the end of the day, I can then decide, look, like, do I want this exposure to the market, to this kind of chart? Or do I want to put that money in a bank and earn, a 5% a year interest that is always going to be predictable? It's not going to go up or down. Interest rate may change, so it can become smaller, but it's always going to be going up, but probably on average by a smaller amount. So I can sort of compare these two scenarios in my head and decide what level of risk am I comfortable with. Now, once you've decided to commit to a given strategy, what is your habit? Well, probably a good habit is to, again, decide up front, is it a once-off thing? I put some significant amount of money that is sitting on my account right now all at once into an ETF. Or maybe I want to take like a series of trades over time. Yeah, so splitting that, because I don't know, maybe the market is going to go down a little bit in the next month. So maybe if I split that money into small portions, I can now decide, well, I could be allocating some 10% of my overall investment that I've decided to do in small slices over, let's say, 10 months or 10 weeks, whatever I decide. Yeah. So that helps me sort of, on one hand, it helps me sort of manage the risk a little bit about what the price fluctuations will be over that course of time. On the other hand, it protects me from a bit of regret, because let's say in 10 weeks time market goes down, and if I put all my money at once without splitting over time, I might miss out on that discount that will happen in 10 weeks time. And then you might choose to commit to a given strategy. Let's say put 10% of your salary each month or every 2 weeks into ETFs. So you would do those trades consistently in order to accumulate some larger amount that is going to grow with that index that your ETF tracks. Okay, or you just decide and forget. So you decide what it's going to be, but if you're committing to a given strategy, the habit would be to be allocating that money over time in accordance to that. Okay, and I recommend, like, very often people like to check what that money does. Is it going up? Is it going down? It's irrelevant what it does, unless you're trying to trade, and that's not what we're talking about. We're talking about investing for the long term. If you're meant to get this investment into the market and set and forget for 10 years, that's what you should do. Checking whether it went up or down on a given day won't change very much. Even more so if the market is doing badly and financial crisis happen and COVID-19 happen or whatever other events, like, don't sell your ETF in the down market, because if you committed to 10-year exposure and you don't strictly need money at that point in time, you should be prepared to wait out the bad weather. Okay, so it's this mental exercise of, like, looking at the graph before you're committing to buying this ETF and simulating the different scenarios that should prepare you to wait out the bad times.
Yeah. Well, thank you for sharing all of that, Marta. That was incredibly insightful. I learned so much from this. Now let's go into the open mic section. This is your opportunity to talk about anything that you're passionate about, and it doesn't have to be related to the topic. So the floor is entirely yours. Please take it away.
No, passionate about. That's interesting. I guess let me take kind of a broad stroke view and say that I'm passionate about people's critical thinking and ability to kind of perceive the world as the world is, as opposed to kind of overlaid with multiple layers of prejudice, our own history, or our conditioning. And it really ties into multiple areas. It ties into meditation, let's say. So meditation is one tool that helps us to train our mind and think more clearly about the world. It ties into data analysis, which I teach. And it's we try usually when we do data analysis to let the numbers speak, as opposed to creating stories without evidence. It ties into politics as well. So as we analyze different kind of political outcomes, either in Australia or overseas, we try to judge who's going to do more good for ourselves or children in running a country, and kind of seeing the cause and effect clearly is helpful. It ties into my own background. So I'm Ukrainian, and it's interesting how speaking to people from different cultures, you see such different perceptions of the same set of facts, and kind of being able to interpret reality is really tricky business because it's very often that each of us has, and it's natural. Everyone carries their own reality within themselves, but being able to agree on facts is definitely important before we can go anywhere further. So all these different themes that emerged from kind of training one's mind to see reality clearly.
Yeah, and a big part of that as well is to have the ability to question yourself and your beliefs consistently.
Yeah, very much so. Yeah.
Yeah, well, thank you so much for spending your time with us today, Marta. It's been such an interesting conversation for me. If our listeners want to find out more about you and what you do, where can they go?
Well, I have a personal blog, which is not so much related to finance. It's more related to Ukraine, but I write on Medium about that. I have a university webpage where there's brief information about me, and I have a Google Scholar, which is an academic tool where people can find my research papers. Okay.
Yeah, we'll link those in the show notes. Thank you once again, Marta, for your time and your effort joining us today. And thank you, everyone, for tuning in. We'll catch you in the next episode. You've been listening to Wealth Pathways, the Affluence Science Insights Podcast, produced by LMSL, the Life Management Science Labs. More episodes are available from 10 life management perspectives and can be found by searching LMSL on Apple Podcasts, Google Podcasts, Spotify, YouTube, and other podcasting apps available on your devices. If you enjoyed this episode, please rate, share, and subscribe to our channel so that other people can find it and we can continue to provide quality content. More of our work can be found on our website at affluence.lifemanagementsciencelabs.com, where you can join our movement. I'm Marie Stella. Thanks for tuning in.